3 stocks at a 52-week low. Great place to start to look for value is when companies hit 52-week lows. Let's check it out. Stock number 1, Pfizer, PFE. Now, if you look back at our history of making Pfizer videos, Mo, what do we always say about the revenue?
Be very careful with this because the revenue is a big bump from COVID.
Yes. And look at the stock, $29 today.
Mm-hmm.
And in 2020...
And probably 21, right?
Yep. This is basically the low. It's close to the low. 23 was the low in March of 2020. So they had all this surge from COVID, and yet the stock is still at 30. Why? Well, I mean, one of the things I'd say is, look at the income statement. I mean, it skyrocketed. Went 53, 40, 32, so drops here, but then 69, 100 billion, and 68. And my guess is it's probably declining even further.
Oh, yeah. I'm going to guess that that's going to keep coming down.
So let's look at the quarterly numbers. So last quarter, reported quarter, they did 13 billion. The same quarter the year before was 22.6. Guys, when COVID isn't as big a deal anymore, and besides Travis Kelce doing his commercial of what is it, 2 for 1? What does he do?
I don't know.
I'll take the 2 at once thing. Like when he's I like Travis Kelce's commercials; they're funny. I think he's a good actor. But either way, this is what we warned about, guys. Just like a company that has a sudden drop for some specific reason, you can't hurt them for that. Just like you shouldn't hurt them permanently for that. Just like you can't help a company give them benefits on a temporary jump.
So actually, if you look at the quarterly revenue, it's doing 13.23 right now.
Yeah.
And if you go, I'm going back to 2016. Look how consistently it's around 13 billion. So maybe 13 billion is kind of
The floor?
The floor for that. I mean, they had a couple of years here and there, but it didn't get crazy until you got into 2020.
Oh, yeah.
So maybe 13 billion is kind of that sustainable level.
Maybe so. So maybe that'll help with our stock analyzer tool when we look at this. Do we have any other information, Mo, on Pfizer? I think they pay a dividend, don't they?
Do they really?
Oh, yeah. 5.5% dividend eats up $9 billion of their cash flow. But guys,
they need to do something.
This $9.11 billion of dividends is almost the entire free cash flow they had last year. So the question, Mo, is how safe is this dividend?
That's a good question.
How safe is this dividend? I don't know. But when you have a company that eats up all of its free cash flow by paying out a dividend, what does it leave them at the end of the day with? They either have to take on debt or take on investors by issuing shares in order to do things outside of that dividend. I don't know if I like that.
Yeah.
The current PE is 15.5. The current price of free cash flow, 15.5. So pretty consistent there. Obviously, the last 5-year PE and price of free cash flow is much lower. It's less than 10. Why? Because in the last 5 years, they had the COVID boom.
Yeah.
They sold a COVID vaccine to everybody 8 times over. All right. So that definitely helped them as a company.
Non-COVID product revenue grew 10% in the most recent filing.
Oh, wow.
So that's good.
That is really good.
Something outside of COVID growing.
And the loss per share is in large part due to a $5.6 billion non-cash inventory write-off. Probably COVID write-off,
COVID, yeah.
Right?
Everything around this is getting back to normal levels without a COVID vaccine drug. That's about it. That's your play here.
Cash flow statement had $3.9 billion dividend income from a JV, from a joint venture last year, but has not reported any cash flow in the most recent year. We should be asking why. So that's a great question to ask. Why did they have a dividend last year from this joint venture and this year nothing? Great questions to ask. Hopefully people in our community are asking those questions with each other. All right. Okay, let's see how much debt. So how much debt do they have? Okay, so they have a $165 billion market cap, right? And they have a $240 billion enterprise value. That difference essentially is debt. So that's $80 billion in debt. When you have rates going up like they are, what's going to happen to those?
Especially if they're variable rates, which they probably are.
Well, even if they're locked in for 5 years, you've got 2 or 3 more years left of these low rates before you're starting to refinance and get a much higher interest charge. So the question becomes, what happens to this net income when these get happen? Or are their revenues and profits going to increase enough to more than account for that? I don't know. I don't know on this one. How does their pipeline look, Mo? Have you ever looked at their pipeline?
Yes.
Why don't you take a look at that, and I'll take a look at their analysis and the 8 pillars, I mean.
So the thing about Pfizer is they've been like the virus people for the world.
Have they?
Yeah. I mean, they are the go-to virus company for the world. So I'm sure they have a pretty good pipeline, but I'm going to look anyway.
Okay, so the 8 pillars here, guys. 4 X's, 4 checks. Like I said, these are misleading, but they're still, the 1 years are still 15.5. These 2 5-year PE and 5-year price of free cash flow. Bought back a few shares. A little bit more debt than our thing wants, but here's the deal. I think this debt number is low because look, it's based on the 5-year free cash flow. The 5-year free cash flow is $17 billion. That's skewed high. So I think this This thing is not, this metric we have here of long-term liabilities, the 5-year free cash flow, is gonna be much higher than 5. It might be upwards of 8 or 9. Is that okay for a company like Pfizer? Maybe, because they're a great company. Mo, what do you got in the pipeline here?
So they have a lot of drugs in the pipeline. 4 in registration, 23 in phase 3, so they're almost there, and they have a lot more in phase 1 and 2. So
the question is, how many of these are marketable drugs that can add to the bottom line, top and bottom line?
So I'm just looking at their areas of focus. These are all pretty revenue-friendly areas.
Yeah, oncology is a big one. Both our fathers being oncologists.
Inflammation, immunology, rare diseases, vaccine. So, I mean, it's not like they're looking at something to do with eyes or cystic fibrosis, which is not the greatest place to be as far as revenue goes.
Okay.
You know?
Got it. What are analyst estimates saying about this wonderful company? All right. They're seeing increases. Big jump next year in profit from $238 a share this year, $324, $350, $367, $370. So growing that.
What's with the revenue?
The revenue they're having flat over a long period of time. So not much revenue growth for this company, according to analysts. So guys, the question becomes, why are we buying this company? Is it a dividend thing? To me, I wouldn't buy this company just for the dividend. And the reason being is, as we showed you, their dividend payout is essentially 95% or 90% of their entire free cash flow last year. So unless you think their free cash flow is really going to skyrocket, that's going to be difficult, okay? So what we have to do is do an analysis here. Now, guys, I talked about the community, talked about the software. If you're interested, 7-day free full access trial. Check it out at everythingmoney.com. Not asking you to make a decision right now. That's why we're giving the 7 days. Go check it out. So, Mo, when was the last time we did Pfizer in our stock analyzer?
The 8th of August.
Mine was May 17th, 2022.
Okay, that's a long time ago.
Yeah. So yours was, why don't we go to yours then, since yours was the 8th of August?
So I did -2, 1, and 4.
Okay.
Profit margin of 20, 24, and 28. Free cash flow margin the same.
I like those. And the reason being, Mo, is yes, the last year has been a skew, but I like these. It's also in line. And even though I don't believe in I don't believe the analysts are the be all end all. Yeah. They're going to provide some guidance. But if they're not optimistic, how can we be optimistic?
Right.
Go ahead.
12, 15, and 18 for the PE and price to free cash flow. And my margin of safety is 12, 14, and 16%. Let's see here.
All right, it's getting close.
$27. So
it's getting close.
Yeah, it's getting there. It's getting there.
Okay, stock number 2, WBA, Walgreens. Guys, I used to own this company. I sold it because I just didn't like the return on invested capital. This was my big glaring issue.
What return on invested capital?
Exactly. 1.1%. For those of you who are new, this means they don't get any return on the money invested in their business. They have a huge dividend of 9.2%. It pays out $1.66 billion. Their 5-year average free cash flow is $2.9 billion. I think CVS personally is a better option than Walgreens. Now, if you look at analyst estimates, they're expecting to make a lot of money per share, and it's selling for a cheap amount of money per share based on 5-year averages. If you look at the 5-year PE, it's at 11. 5-year price of free cash flow is 6.2. I think this is the kind of company you play for a pop because it's really gotten beaten down hard lately.
Look at price to sales. 0.13.
0.13.
Mm-hmm.
The all-time 52-week high, the all-time high was August 5th, 2015 at $74 a share. Its low was $19.68 just last week.
Wow.
Yeah. Maybe I should be looking at this again. I actually probably should be. It doesn't fit my criteria for owning a company forever, but it fits the criteria of maybe a pop. Has it been oversold? I don't know, but I look at this thinking, oh, man. This company has a lot of debt, which is understandable because they have...
So does CVS.
Yeah, but they have a lot of great locations. That doesn't bother me. And by the way, I like Walgreens. I go to Walgreens and CVS. I love them. They're the biggest ones, of course. I just, you look at these analyst estimates. Look at the 8 pillars, Mo. No, I'm actually surprised.
Not bad. They should be buying back shares.
They should be buying back... They should stop their dividend and spend every single dollar buying back shares. True or false, Mo?
Definitely. What's with the free cash flow?
Look at that $1.7 billion in dividends. They'd be buying back almost 10% of the company every single year. Why would you ever waste your time paying a dividend? Guys, don't fall for that trap.
They don't want the price to fall lower.
Yeah, don't fall for that trap, though. All the more reason. Cut the dividend. The price falls. They buy back even cheaper shares. Reward your investors who stuck with you. Stock number 3, Alibaba. Guys, I own Alibaba, but again, don't own a company just because I do, and don't own a company just because anybody on the internet does. We're here to teach a process that you can apply to every company. Here are the risks with Alibaba. China. There's a lot of unknowns there. Remember, companies don't sell cheap without some sort of story being told That's the question is this story bad enough? It's at $73 a share right now. I think the low in the last couple of years was $58, but the all-time high was almost $320 just 3 years ago. And now it's at $73 a share, almost an 80% drop. Now, they're generating a lot more cash flow. Revenue is up like 9% last quarter. There's a lot of positives in the area, but it's being priced, in my opinion, like a dead company. The current price of free cash flow is 6. They're reporting more free cash flow than income. Remember, on our analysts here, we have to go to annual report here on all of our income statement.
People freaked last week when Jamie Dimon said JP Morgan Chase would exit China if ordered to.
Yeah, and by the way, China is a big contributor to the world economy. They rely a lot on the West. Is it possible they still go rogue and go crazy? Absolutely, that's possible. And that is that's my biggest risk on Alibaba, is them doing something stupid that temporarily drops the price significantly. Because remember, when the stock first started dropping, the big story was, you don't even own the shares or ADRs and blah, blah, blah. Okay, sounds good. Sounds good. Now that story has stopped. Why? Because people just moved on from it. And who knows what happens with China, Taiwan, and the West. There's always a lot of contention there. However, we rely on China a lot. They rely on us a lot. If all of a sudden we stopped buying goods from them, what would happen to their economy? They're the fastest growing. Bye-bye. They're the fastest growing middle class in the world. They have their issues, and that's why I believe the stock is selling cheap.
Honestly, look at what happened in the last couple of years when we've started using other places. They've been hit pretty good.
Yeah.
Imagine if we just stopped.
Yeah. So, guys, my opinion on Alibaba is, let's pull up a stock analyzer tool. So I'm going to pull up BABA. Now, remember, I don't think my BABA analysis factors in China going to war and being shut down. So I did this 5, 8, and 12% revenue growth. Let's do this, though.
Do you think we can add a line for that?
Yeah, you can do -5, 0, and 5. In desired return, I'll go 14, 17, and 20.
Okay.
I did profit margin of 15, 19, and 23. Free cash flow 17, 22, and 27. And a PE. It's still green in the middle.
Wow.
So the question becomes, are we going to look back at history and go, this was a terrible buy? Or are we going to look back at history and say, hey, it was so ridiculous what they were saying? Guys, thank you very much for your time.